So the premium payments will stop at age 50. On this 20-pay life, when will cash value equal face amount? Definitely something you need to understand. Did I hear you say 100? Of course. Cash value equals face amount on whole life policies at age 100. What do you think about the premium payments for this policy versus the one that we just discussed, the LP65? More or less on an annual basis? I would say more. The truism says the shorter the pay-in period, the higher the premium. So let's say that the premium is $3,500 a year. What do you think about the cash value at age 50? Is it more or less than the previous policy had at age 50? More. Because in this story, all of the premiums are paid in by age 50. Cash value equals face amount when? Age 100. So feel comfortable with the two different ways the limited pay policies can look. Remember, it's still a type of whole life. The last type of limited pay that you need to feel comfortable with is called a one-pay life. So let's just say that you inherited some money and you wanted to pay your entire premium up front in the beginning. So a one-pay life. So here you are at age 30 and you pay in the whole $70,000 right away in the beginning and you're never going to pay again. Now in the real world, they're going to give you a nice discount for doing this all at once. But for purposes of the test, we're just going to understand the basics of how this would work. So at age 30, you paid in all $70,000. You never pay again. A one-pay life policy is the only policy that we will discuss that will have immediate cash value. It better, if I'm going to give them $70,000 all at once, I better be able to the next day take out a loan. So you are allowed to take out a loan right away in the beginning if you have a one-pay life policy. Cash value equals face amount when? Age 100, just as always. Now let me ask you this. If you think back to that ordinary whole life policy versus this one-pay life, if you were to die in the very first year of this policy, which one was better, I hate to say it like this, but better bang for your buck, if you will? One-pay life or ordinary whole life? Ordinary whole life would be better as far as you would have paid a much lower premium to have the same amount of protection if you had died in the first year. So one-pay life. That is number one under traditional whole life and number two under your traditional whole life category. Going on to page 2. On page 2 we have number 3, the modified premium and graded premium. We're still talking about whole life policies. These policies are really marketing tools. You know you have a client that wants whole life, but for whatever reason they can't afford it, the whole entire premium right away in the beginning. A client that is good for this policy, modified or graded, would be someone just out of college or medical school or law school. What do you have today when you get out of school besides the ability to get a job? Typically today you'll have a lot of debt, a lot of money owed back to someone, be it a credit card company or a student loan company. So really that's what these were originally designed for. Modified and graded policies. Good for clients whose income is expected to increase in a few years. Now these policies are very similar in who they're sold to, but they have a slight difference in how they work in the beginning years. So modified, purchased at age 30, the same face amount, $100,000 as we've been talking about. The premium is lower in the beginning years. Let's say for the first 5 years, the premium is $700 a year instead of the typical premium of the $1,000 that we talked about at the beginning of this section. So that, let's say it was you're just out of law school and your wife just had twins and you need to have protection, you want the $100,000 policy, but you're still paying off all your loans and the baby's diapers cost a lot of money. So you ask me, I'm your agent, if there's any way that you can get the same amount of protection, but only have to pay less for it. So how many years? It depends upon the company. 5 years, 4 years, 6 years. We're just talking about in general how this policy works. You pay in less. If you die at 31, how much protection do you have? You have the full face amount. So the premium is less, but the protection has not changed. After the beginning years, it will go up. It will be above what it would have otherwise had to have been. So for the rest of this policy, you'll be paying, let's say, $1,200 a year. It is modified whole life, which means it is permanent protection, lasting until what age? That's right, age 100. Cash value equals face amount, just as always, at age 100. What do you think about the cash value in the beginning years of this policy? Does it grow more quickly or more slowly than usual? More slowly, of course, because you are paying in less. Graded premium policies, the premium's going to increase in the beginning years. So if you purchased it at age 30, the first year, let's say it's $500, and then it's $600, and then it's $700, and then it's $800, and then it's $900. So graded, it helps me to remember, is a gradual, G&G once again, a gradual increase in premiums in the beginning years of this policy. So that the premium goes up in the first 4, 5, 6 years, depending upon the company. Once again, it goes above what it would have otherwise had to have been. Cash value equals face amount at 100. What if you have graded whole life and you die at 32? How much is paid? The full face amount. All that has changed is the premium payments in the beginning years. Number 4 on page 2 is called adjustable whole life. This is adjustable. This is sold to someone who's in a commission-based profession. So adjustable whole life is someone that's on commission. So someone just out of college, that was graded and modified. Adjustable whole life is a stockbroker, a real estate producer, a car salesman. These are the examples that they typically use on the test. Someone whose income might be great one year and not so great because of economic conditions the next year. So adjustable whole life. Adjustable whole life allows the client to adjust the premiums up and down to suit the economic conditions of the client. In changing the premiums, they will be allowed to change the face amount up and down, which we'll discuss. It is a combination product. You need to memorize the fact that part of this policy is term insurance. Term insurance we haven't even learned about yet. Term insurance is pure protection. It has no cash value. It's cheapest in the short run. We'll talk all about it in just a moment. And part of it is interest-sensitive whole life. So that how much is how much, what percentages are there, we're not really sure until we've looked at how this premium has changed. So let's say that you purchase an adjustable whole life policy because you are an insurance producer and you got a policy with that face amount of $100,000 and your first premium is $1,000. And for the first few years, that's acceptable to you. You can afford that. But let's say 5 years from now, you just can't quite swing the full $1,000. Would you be allowed to pay in less? Yes. That's why you have purchased adjustable whole life. When you pay in less, what do you think is going to happen to the face amount? It is going to go down. Now, just to review, with modified and graded, what happened when you paid in less in the beginning? You had the full face amount. So this policy is different. This policy says when you pay in less, let's say that 5 years into it you paid in $700. If you die that year, your face amount has gone down to $90. The face amount does change as you adjust your premiums. Now you're having a much better year this year and you want to be able to pay in more. You can pay in whatever the premium would have to be to get your protection back to what you were originally underwritten for. But you cannot increase your face amount without a physical. That is important to understand. So what you can do is you can adjust it down and up, but only up to what you originally purchased when you got your policy. If you want to buy more insurance later on, you'd have to pass a physical to be able to buy more insurance. It'd be based upon your age at that point, your health, your hobby, all of that. This policy can never go above what you were originally underwritten for, so $100,000. Adjustable whole life. Who is it sold to? Someone that's in a commission-based profession. That summarizes our discussion of these traditional whole life products. So you can bet you'll have a question or two at the most about each type of whole life that we have discussed so far.